In 2015, a group of people in San Francisco started a nonprofit. The stated mission was to ensure that artificial general intelligence AI smarter than any human would benefit. And I'm quoting directly here, all of humanity, not investors, not shareholders, not a board of directors, all of humanity. It was a noble idea. They raised about $1 billion from donors, including Elon Musk and Peter Thiel. They hired researchers. They did research. They published it freely. They were a nonprofit. They were the good guys. That company is now preparing to go public on the stock market at a valuation of $1 trillion. It loses $1.22 for every single dollar it earns. Its projected loss for 2026 alone is $14 billion. Its cash burn by 2027 is $63 billion per year. It will not be profitable until 2030 at the earliest. And the CEO, who has run this company since 2019, who turned it into the most transformative technology company of the last decade, who personally convinced every major investor to write the checks that funded all of this, that CEO owns zero equity in the company. His name is Sam Altman. His compensation in 2023 was $76,001. In San Francisco, where he owns a $27 million mansion, the median household income is higher than what OpenAI paid its own CEO to run a company now worth nearly $1 trillion. We're going to talk about three things. First, how a nonprofit that was supposed to benefit humanity became one of the most aggressively commercial companies in Silicon Valley. Second, what you are actually buying when you buy OpenAI stock, including who owns what, who controls what, and why. Those are two very different questions. And third, the number that makes every analyst projection fall apart, and why OpenAI is going public right now specifically, not because it wants to, but because it has no choice. Let's start at the beginning, because the origin story matters more than people realize. OpenAI was founded as a nonprofit in 2015 for a specific reason. The founders genuinely believed that building artificial general intelligence, a system more capable than any human across any task, was the most dangerous thing anyone could attempt to do. They also believed it was inevitable. So their logic was, if this is going to happen anyway, it should be built by people who aren't trying to maximize profit. That was the founding thesis. It is important to hold that sentence in your mind for the rest of this video. By 2019, that thesis had a problem. Training frontier AI models, the kind of models that become chatgpt, costs hundreds of millions of dollars per run. The nonprofit could not raise that kind of money. Donors do not write checks large enough to train GPT-4. So OpenAI did what any organization does when its ideals collide with its budget. It created a workaround. It invented something called a capped profit structure. The idea was elegant in theory. A for-profit subsidiary would sit underneath the nonprofit. Investors could put money in and get returns, but those returns were capped at 100 times their investment. Any profit above that cap would flow back to the nonprofit and through it to humanity. The nonprofit retained control. The mission was preserved. Everyone was happy. The profit cap was 100 times the original investment. If you invested $1 million, you could make at most $100 million, which sounds like a meaningful limit until you realize that 100 times a large number is still an extraordinarily large number. Microsoft invested approximately $13 billion under this structure. 100 times $13 billion is $1.3 trillion. So the cap that was supposed to protect humanity from runaway profit was set at $1.3 trillion for a single investor. The cap was not really a cap. It was a formality that made everyone feel better. By 2021, the cap had already been quietly reduced, not to zero, not to something conservative, but to single digits, meaning somewhere between 2 and 9 times the original investment. OpenAI did not announce this change publicly. It was revealed by investigative reporters at The Information and The Economist. The company continued to describe itself as a capped profit organization without disclosing that the cap had changed. By October 2025, the capped profit structure was abolished entirely. OpenAI converted itself into a public benefit corporation. a for-profit company with a stated social mission, the same legal structure used by companies like Patagonia and REI. The nonprofit was renamed the OpenAI Foundation and retained 25.8% equity. The mission, technically, remained the same. The structure that was supposed to enforce the mission was gone. Now let's talk about the cap table, because this is where the story gets genuinely strange. As of early 2026, the major shareholders in OpenAI look like this. The OpenAI Foundation, the original nonprofit, the entity that was supposed to represent all of humanity, owns 25.8% of the company at zero cost. That stake is currently worth approximately $219 billion. Zero cost. Infinite return multiple. The nonprofit that couldn't pay for frontier AI research without creating a for-profit subsidiary is now sitting on $219 billion of equity. Microsoft owns 26.79%, worth approximately $228 billion on a $13 billion investment, a 17 times return. SoftBank has committed $64.6 billion and holds a stake worth approximately $99 billion. Amazon, Nvidia, Andreessen Horowitz, D.E. Shaw, T. Rowe Price, all invested in the March 2026 round at an $852 billion valuation. And Sam Altman, the CEO, owns zero. His equity line in the cap table literally says TBD. The man who turned a nonprofit research lab into the company that effectively triggered the global AI race, who navigated a board that tried to fire him in 2023, who has been the public face of artificial intelligence for the last 3 years, who convinced every investor on that cap table to write their check. His compensation is to be determined, pending, apparently, a future IPO. In the meantime, he was paid $76,000 a year. For context, a mid-level software engineer at Google makes more than that. A senior prompt engineer at a startup makes more than that. The CEO of the most important AI company in the world was paid less than a high school teacher in California. There are 2 ways to interpret this. The charitable interpretation is that Altman is independently wealthy from other investments, doesn't need the money, and structured his compensation this way to signal that his motivations are pure and mission-driven, rather than financial. The less charitable interpretation is that operating under a nonprofit tax structure while having zero personal financial upside is exactly what a nonprofit is supposed to look like, and the moment the company converts to for-profit and goes public, Altman will be awarded equity worth billions of dollars, compensating him for years of below-market pay in a single transaction that will be framed as a reward for his vision rather than a correction of a structural anomaly. Both interpretations are possible. One of them is more consistent with the pattern of behavior over the last 7 years. Now let's talk about the IPO itself and why it is happening right now. The answer is not that OpenAI is thriving and wants to share the upside with public investors. The answer is that OpenAI needs money in quantities that private markets can no longer provide. Here are the numbers. In 2025, OpenAI generated $13.1 billion in revenue and spent approximately $22 billion to generate it, producing a net loss of roughly $9 billion. In 2026, revenue is projected to reach approximately $25 billion, and the projected operating loss is $14 billion, meaning the gap between revenue and costs is actually widening, not narrowing, as the company scales. In 2027, projected cash burn rises to $63 billion in a single year. HSBC analysts estimate that OpenAI will require over $207 billion in additional capital through 2030, just to honor its existing compute commitments and infrastructure deals. For comparison, $207 billion is larger than the GDP of Portugal. OpenAI has signed infrastructure contracts that are staggering in their scale. It has committed to purchasing $60 billion per year in compute from Oracle. That's a $300 billion contract over 5 years, starting in 2027. It has an AWS deal with Amazon worth $38 billion over 7 years. It has committed to purchasing $250 billion in Azure compute from Microsoft as part of the partnership renegotiation finalized in May 2026. These are not aspirational numbers. These are signed contracts, and they come due whether or not revenue grows as projected. The IPO is a forced funding event. OpenAI's CFO, Sarah Frier, reportedly pushed back internally on the IPO timeline, citing the gap between what the company has committed to spend and what it currently earns. The California Attorney General reviewed the nonprofit conversion and approved it with conditions. The legal last major obstacle was cleared when a California jury dismissed Elon Musk's lawsuit against OpenAI in May 2026, removing what had been an institutional overhang on the company's restructuring. Within days of that dismissal, Goldman Sachs and Morgan Stanley filed the confidential S-1 registration. The timing was not a coincidence. So here is what you are actually buying when you buy OpenAI stock. You are buying exposure to a company generating $25 billion a year in revenue, which is genuinely impressive, and growing fast. Annualized revenue went from $6 billion in 2024 to $25 billion in early 2026, a rate of growth that almost no company in history has matched. You are buying a company that every major technology platform, Microsoft, Amazon, Apple, Oracle, has bet on as the foundational layer of AI infrastructure. You are buying 50 million consumer subscribers paying monthly for chatgpt, 9 million business users, 15 billion API tokens processed per minute, and enterprise contracts growing fast enough that enterprise revenue is on track to equal consumer revenue by the end of 2026. You are also buying a company burning $63 billion a year by 2027. You are buying a company that is not committed to a path to profitability until 2030 and whose 2026 revenue projections have already been revised downward from $85 billion to $39 billion following the Microsoft renegotiation. You are buying a company whose CEO owns zero equity and whose compensation arrangement has not been disclosed. You are buying a governance structure where the OpenAI Foundation, a nonprofit that was founded to represent all of humanity, owns 25.8% of the company and controls 100% of board appointments, meaning that technically, the entity governing the company you're buying stock in is accountable not to its shareholders, but to its charitable mission. And that mission, as originally stated, was to ensure AI benefits all of humanity, not to generate returns for the people who bought shares in September 2026. The bull case is real and should be said clearly. If Sam Altman's projection of $100 billion in revenue by 2027 is correct, even roughly correct, then a $1 trillion valuation at listing becomes defensible on a forward revenue basis. ChatGPT is already the fastest growing consumer product in history. The enterprise market for AI agents, which OpenAI projects will reach $29 billion in revenue by 2029, is in its first inning. Every company in the world is trying to figure out how to replace labor costs with AI subscription costs. And OpenAI is the company most likely to capture that transition. If it works, this is the infrastructure play of the century. If it doesn't work exactly on schedule, if compute costs don't fall as fast as projected, if a competitor closes the capability gap, if enterprise adoption plateaus, if the Microsoft partnership creates more friction than expected, then the company going public at $1 trillion with a negative 122% operating margin and a $63 billion annual cash burn is exactly the kind of thing that ends careers on Wall Street. OpenAI was founded to make sure that artificial general intelligence benefits all of humanity. That mission is written into its certificate of incorporation. It has not changed. It will still be on the cover page of the S-1 when the public filing goes live in August. The company that files that S-1 will be raising $60 billion from public investors on a market where automated index funds will buy it regardless of the fundamentals. Run by a CEO whose equity is to be determined, burning $63 billion a year by 2027, governed by a nonprofit with an infinite return multiple, formerly subject to a profit cap that was quietly reduced, and then abolished without public announcement, and described, in good faith or otherwise, as being for the benefit of all humanity. You will probably be able to buy it. Whether you should is a question that, technically speaking, only you can answer. Sam Altman cannot answer it for you. He doesn't have any skin in the game. Yet,